What if one day you walk down the street and someone handed you $1 million? There's only one condition to this money. You must invest it all in the stock market over the next 5 years. What would you do? Welcome to Money Insiders. My one and only goal is to increase your financial literacy by 1% every video. Here we have Joe. Joe did some research, watched a lot of YouTube videos on various strategies, and decided to go all in immediately because time in the market is better than timing the market. Then there's Bob. He subscribed to Money Insiders and decided to chop up the $1 million into 10 equal chunks of $100,000. He then invested it every 6 months like clockwork. On this channel, we like to give realistic worst case scenarios so you can see the actual picture. Let's look at the historical data for the S&P 500 over the past 50 years. We see these two crashes here. They're the 2000 dot-com bubble and the 2008 financial crisis. In year 2000, we started the index at 1463, then it crashed at a bottom of 800 around September 2002. Imagine how Joe feels at this moment. His $1 million has dropped 45% or $450K. His anxiety is getting to him and he just wants to sell it all. Bob, on the other hand, has invested $600,000, losing $213K. With $400,000 in cash, he has a net asset value of $787K. He feels a little queasy, but knows that he still has 4 clips of $100,000 to invest at the low points over the next 2 years. All his confidence is based on the fact that he trusts the market will trend upwards over time. In 2008, we started the index at 1410, then it crashed to the bottom of 730 around March 2009. This time Joe is sick to the stomach, as his $1 million has dropped almost half to $520K. He just wants to crawl up, click sell all at market, and leave the market forever. Bob, on the other hand, have invested $300,000, losing $109K with $700K in cash. He has a net asset value of $891K, so he only lost 11%. He's feeling perfectly fine because his dollar cost averaging system is built to handle 20+% swings, especially during the early stages. He still has 7 clips of $100K to invest over the next 3.5 years. At these low points, you'll build up quite a sizable position. We see that for this 2008 crisis, Bob has lost 35% less than Joe at the bottom, and 24% less during the 2000 crisis. Capital preservation is key for the long game, right? For the dot-com bubble 5-year summary, we see that with the dollar cost averaging method, we accumulated a lot more units or stocks during the low tides. Therefore, this portion will have much larger gains when it bounces. Here we see that Joe is down 19.13%, Bob is up 3.32%. Bob is ahead of Joe by 22.45%. For the financial crisis 5-year summary, same idea here. We accumulated almost 30 to 40% more units during these low tides. Here we see that Joe is down 0.01%, Bob is up 21.7%, Bob is ahead of Joe by 21.71%. In both crash instances, Bob beat Joe by 20+% on the upside and lost 20+% less at the market bottom. There's a saying that if you manage the downside, the upside will take care of itself. Who would you rather be, lump sum Joe or dollar cost average Bob? Warren Buffett has a quote that says, "I always knew I was going to be rich, so I was never in a hurry to." So what do you think? Have I increased your financial literacy by 1%? If yes, then consider subscribing, hit the notification bell and dropping a like. Otherwise, you can comment and let me know how I can create more value for you. Take care and have a good one.